Dividend hikes have historically been a powerful catalyst in the REIT sector. Most REIT investors care a great deal about the dividend, and therefore dividend hike announcements are typically met with immediate upside as investors rush to buy the stocks and bid it up to higher levels. Therefore, a simple yet powerful investment strategy is to simply target REITs with rapid dividend growth potential. The rough math is that if you earn a 5% dividend yield and this dividend gets hiked by 5% per year, then investors can expect to earn 10% annual total returns, assuming that the dividend yield remains intact. But now that interest rates also being cut, we expect some of that 7 trillion currently sitting in money market funds, a record high, to make its way back to the REIT sector as their dividend yields will become increasingly compelling in a lower yielding world, and this has the potential to push their valuations to higher levels. As an example, if a REIT is today trading at a 5% dividend yield and gets repriced at a 4% dividend yield level, that would result in about 25% upside. And now assuming it takes 3 years for this full upside to be realized, it would add 8% on average to the annual returns over the next 3 years. So taking back our earlier example, 5% dividend yield plus 5% annual growth plus 8% annual repricing upside, and you would earn about 18% total returns over the next 3 years on average. And there are many such opportunities today in the REIT sector. In today's video, I'm going to highlight 3 of them. Hey, this is Jos, I run a small investment firm that specializes in REIT investing, and before going to today's video, I want to let you know that we've just launched a new series at High Yield Landlord to highlight our top picks for 2026. And you can access it for free today with our 2-week free trial. It will be the first link in the description of this video. You won't be charged anything in the first 14 days. You can join, check this new series, review our top picks for the next year, and you can cancel no questions asked at any time and you won't be charged a penny. But if you enjoy the service, you can stick with us for the next year and you'll also get a special discount by joining today. So the first company that I'm going to discuss here is called Sila Realty Trust, ticker symbol SILA. It's today offering a 6.8% dividend yield, and we think that it's in a position to grow its dividend by about 5% annually going forward. This growth is expected to come from 3 sources. Firstly, its portfolio of healthcare net lease properties has long leases with 2% average annual rent escalations. Secondly, the REIT retains about 30% of its cash flow to keep acquiring new properties organically with its retained cash flow. Third, the REIT has today an under-leveraged balance sheet with a low 20% loan to value, which puts it in a position to now take on new debt to acquire more properties, earning large positive spreads over its cost of capital. All in all, we expect this to result in about 5% annual growth in its FFO per share, and given that its current payout ratio is only about 70%, we expect that to also lead to steady dividend hikes going forward. Therefore, assuming that the company's valuation multiple and dividend yield remains intact, today we have a 6.8% dividend yield plus a 5% annual dividend growth rate. This should result in 11.8% annual total returns. But we think that there is additional upside from yield compression as interest rates are cut and more capital from fixed income shifts to the REIT sector. I think that a REIT like Sila will become increasingly attractive for yield-starved investors, and this has the potential to reprice it at closer to a 5% dividend yield, which would lead to 30% upside from here. Assuming that it takes 3 years for this upside to be realized, here we have a 6.8% dividend yield, 5% annual growth, plus about 9% annual returns from repricing. Putting that all together, you have 20.8% average annual total returns. And I think that that's very attractive coming from a REIT that owns recession-resilient properties and has relatively low leverage. For this reason, we own a relatively large position in Sila at High Yield Landlord as part of our core portfolio. And by the way, by joining us for the 2-week free trial to access our series on top picks for next year, you also gain access to my full real money REIT portfolio. The second company that I want to highlight here is called VICI Properties, ticker symbol VICI. It's currently offering a 6% dividend yield and just recently it hiked its dividend by another 4%. We expect similar growth going into 2026, and then this growth to potentially accelerate as interest rates are cut and VICI eventually regains a lower cost of capital, which will allow it to return to more aggressive acquisitions at larger spreads. For context, VICI has historically managed to grow its dividend by 7% per year on average since its IPO, and that's despite going through a pandemic, which was arguably the worst possible crisis for a casino REIT. In case you're not familiar with VICI, is the leading casino net lease REIT, owning some of the most iconic casinos in the world, including the Caesars Palace, MGM Grand, the Venetian, and many others. Its properties are leased on a triple net lease basis, which means that its tenants are responsible for all property expenses, including even the maintenance, and it enjoys 40+ year long leases, resulting in highly consistent and predictable cash flow. And unlike Sila, which has fixed rent escalation in its leases, just like most net lease REITs, VICI is different in that it has CPI-based rent escalations in a lot of its leases, which are resulting in better inflation protection and faster rent growth. Today, the REIT retains about 30% of its cash flow to keep acquiring new properties, and even in today's market, still able to access capital at a cost that's inferior to the expected return on its new acquisitions, given that cap rates are quite high in the casino sector. Long term, we expect VICI to grow its dividend by about 5% per year on average, which should result in about 11% annual total returns, putting a 6% dividend yield and the 5% growth rate together. But as interest rates are cut, we would expect VICI to also see some yield compression, and if it reprices at say a 4.5% dividend yield, that will result in about 33% upside from here. Assuming that it takes 3 years for this upside to be realized, it would add another 10% to the annual expected total returns, resulting in 21% average annual total returns over the next 3 years. And once again, I think that the risk reward is very compelling, coming from a REIT with true Class A trophy assets, a strong balance sheet, and an exceptional track record. Hey, before I go into the third REIT, can you please do me a huge favor and click the like button if you're enjoying this type of content? It helps me a lot to keep on growing. Thanks so much in advance. The third REIT might surprise some of you for today's list, but it's Mid-America Apartment Communities, ticker symbol MAA. And the reason why I'm saying that this pick might surprise some of you is because over the past few years, its dividend growth has been rather disappointing. The apartment sector, especially in Sunbelt markets, have been oversupplied, and this has resulted in stagnating or even slightly declining rents and occupancy rates. This has been a major headwind for REITs like Mid-America Apartment Communities, especially as interest rates surge at the same time. However, we expect conditions to improve significantly already in the near term in 2026 and even more so in 2027, given that new construction activity for apartment communities has now dropped to a 10-year low. Apartment community developers have gotten hurt because of the oversupply, and as a result, they've significantly scaled back new projects. Right now, there's still a decent amount of new units being delivered despite the oversupply, because there is a mismatch between the timing of when a new development project is launched and when it hits the market. And unfortunately for those who are now hitting the market, they are losing their shirts in many cases. But we expect these new deliveries to now gradually keep declining to historic lows, and eventually the demand will catch up to the now much lower supply, which will lead to a faster rent growth. And I think that we might be going into this new period of undersupply already in the near term. I don't know exactly when it's going to be. Is it going to start in mid-2026, in 2027, mid-2027? I'm not 100% certain, but I think that it's very likely that we're going to go into a period of undersupply in these rapidly growing Sunbelt markets, given how little new construction activity is today taking place. And as we enter this new period of undersupply, we expect its dividend growth to accelerate significantly, and it could reach about 6%. And given that today it's offering a near 5% dividend yield, add to that 6% annual growth in dividend, you're getting an 11% economic total return, assuming that the dividend yield remains intact. But that's not all, given that the valuation is today historically low, trading at a 25 to 30% discount to NAV, a 10-year low valuation. Just to return to its consensus analyst NAV estimate, the stock will need to rise by about 30% from here. Again, assuming it takes 3 years for this upside to be realized, it would add about 9% to annual total returns, resulting in about 20% total annual total returns over the next 3 years. And once again, I think that that's very compelling coming from an A- rated blue chip apartment REIT. The point that I try to make in today's video is that there are a lot of dividend growth REITs that are in a position to deliver 15 to 20% average annual total returns over the coming years, as they deliver a high dividend yield, keep growing this dividend consistently, and eventually reach a higher valuation as interest rates are cut and more money from fixed income make its way back to the REIT sector. At High Yield Landlord, we're seeking to capitalize on these REITs that offer the best combo of yield, growth, and upside. And if you want to access our full portfolio, you can join us for a 2-week free trial. It will be the first link in the description of this video. Thank you very much for your interest. Again, if you can click the like button, it helps me a lot. See you at my next one. Bye-bye.